We often look to the South China Sea for signs of conflict. The roar of stealth fighters or the imposing silhouette of a US aircraft carrier strike group. But as of late 2024, the most lethal maneuvers aren't happening in the water. They're occurring on digital ledgers in Manhattan and Washington. This is the silent front. Historically, financial first strikes have crippled empires faster than artillery. In 1956, the US ended the Suez Crisis not with kinetic force, but by threatening to liquidate the British pound, forcing a global superpower to retreat in weeks. Today, the tactical landscape has shifted. China's divestment of US Treasuries, plummeting to approximately $688 billion, according to recent Treasury International Capital data, represents a modern evolution of this economic warfare. While military posturing is visible and noisy, sovereign debt liquidation is quiet and corrosive. Industry reports indicate this isn't merely a reaction to market volatility, but a calculated financial attrition timeline. Following the 2022 precedent where Russian central bank assets were frozen, Beijing appears to be moving beyond the theater of war and into the logistics of survival. By rotating out of the dollar and into hard commodities, they are neutralizing the US government's most potent leverage, the global reliance on American debt. This $688 billion figure isn't just a data point. It is a tactical withdrawal from a financial system China no longer deems safe. The true conflict is not looming on the horizon. It is already being fought in the plumbing of the global economy. As of late 2024, the Treasury International Capital, or TIC, data provides a sobering autopsy of a dying era. The figure of approximately $688 billion represents more than just a balance sheet. It is the lowest level of Chinese holdings of US sovereign debt in over 14 years. To grasp the magnitude of this shift, we must look at the historical trajectory. At the peak in 2011, Beijing held over $1.3 trillion in US Treasuries. We are witnessing a nearly 50% liquidation of what was once the world's most significant financial marriage. The contrast with previous cycles is jarring. During the 2008 global financial crisis, China acted as the buyer of last resort, aggressively purchasing treasuries to stabilize the global system and protect its own export-led economy. Today, the script has been flipped. According to the most recent TIC reports, China is no longer the stabilizer. They have become a primary source of downward pressure. This brings us to a critical question. Why sell now? With the Federal Reserve maintaining a high for longer interest rate environment throughout 2024, bond prices have cratered. Selling in this market means locking in massive realized losses. To a traditional fund manager, this looks like a catastrophic financial blunder. However, within the framework of financial attrition, this is a calculated maneuver. Geopolitical analysts suggest that Beijing is currently paying a strategic exit premium. It is vital to distinguish between mark-to-market accounting losses and active divestment. As interest rates rise, the market value of existing bonds automatically drops on paper. While a significant portion of the decline from 1.3 trillion to 688 billion is indeed due to this valuation drop, the underlying data shows a consistent, active purge of holdings. They aren't just watching their portfolio shrink, they are actively pushing it out the door. For the Chinese leadership, the realized loss on a 10-year treasury is a secondary concern compared to the existential risk of an asset freeze. Following the 2022 precedent, where Russian central bank assets were neutralized, the safety of the dollar has become a localized illusion. Beijing isn't losing money in the traditional sense. They are paying an insurance premium to neutralize Washington's most potent leverage. In this clinical autopsy of the TIC data, we see that for China, the $688 billion figure isn't an accidental low. It is a deliberate destination. To understand why Beijing is willing to lock in billions in realized losses, we have to look back at the precise moment the global financial architecture cracked. In February 2022, following the invasion of Ukraine, the United States and its G7 allies executed what many analysts now call a financial nuclear strike, the freezing of roughly $300 billion in Russian central bank assets. For decades, the US Treasury was marketed as the world's risk-free asset. It was the bedrock of global trust, a neutral vault where any nation could store its wealth. But as of late 2024, that neutrality has been exposed as a conditional privilege. The 2022 freeze signaled to every non-Western capital that the dollar is no longer just a currency. It is a permission-based asset. If your foreign policy diverges from Washington's, your savings can be deleted with a single keystroke. For China, this wasn't just a geopolitical observation, it was a survival alert. With over $3 trillion in total foreign exchange reserves, Beijing realized they were effectively holding a massive hostage. If the 2022 precedent applies to Russia, the logic follows that it would certainly apply to China in the event of a conflict over Taiwan or a total breakdown in trade relations. Industry reports indicate that this grand pivot shifted Chinese strategy from profit maximization to sanction proofing. Historically, the 1970s petrodollar era was defined by a simple trade. The world bought treasuries in exchange for energy security and U.S. consumer demand. But the 2022 catalyst fundamentally broke that contract. Beijing's rapid divestment toward the $688 billion mark is a clear signal that they now view the U.S. financial system as a weaponized environment. This is the point of no return. Trust is a resource that takes decades to build and minutes to destroy. By turning the global reserve currency into a tool of statecraft, the U.S. may have achieved a short-term tactical victory against Moscow, but it triggered a long-term strategic exodus in Beijing. China isn't just selling bonds because of interest rates, they are liquidating their exposure to a system where they no longer have sovereign immunity. In this new era of financial attrition, the US Treasury is no longer a safe haven, it's a vulnerability. The $688 billion figure we see today is the direct consequence of that 2022 epiphany. In a weaponized financial world, the only true safety lies in assets Washington cannot freeze. As China's holdings retreat toward the $688 billion mark, a glaring question emerges. If the world's largest creditor is walking away, why hasn't the US Treasury market collapsed? The answer lies in what forensic analysts call the proxy mask. As of late 2024, Treasury International Capital data reveals a curious anomaly. While China's direct holdings have plummeted, holdings in specific, smaller jurisdictions, most notably Belgium and the United Kingdom, have seen unexplained surges that often mirror the scale of Chinese selling. Belgium, a nation with a GDP roughly 140th the size of the United States, consistently ranks among the top global holders of U.S. sovereign debt. This is not due to Belgian domestic policy, it is the result of Euroclear. Based in Brussels, Euroclear is a massive international central securities depository that acts as a financial black box. When a sovereign entity, potentially China or its offshore entities, wants to obfuscate its movements or maintain liquidity without the political stigma of direct ownership, they move assets into these custodial accounts. By shifting bonds to Euroclear, the owner on the TIC report changes from China to Belgium. However, industry reports indicate a more strategic layer to this arrangement. These jurisdictions are increasingly acting as political shock absorbers. As the Federal Reserve navigates the high for longer interest rate environment of late 2024, the U.S. Treasury faces a duration supply crisis. To prevent a total auction failure where yields spike to catastrophic levels, someone must absorb the supply. Analysts suggest the UK and Belgium are essentially conscripted buyers, leveraging deep-rooted institutional ties to soak up the excess debt that Beijing is dumping. In this era of financial attrition, the City of London serves as a financial janitor. By routing transactions through UK-based custodians, the true identity of the buyers is often scrubbed, providing a mask that prevents a total collapse in market confidence. This creates a valuation illusion. On the surface, Treasury auctions appear stable, but the data suggests the buyer pool is narrowing to a handful of strategic proxies and custodial hubs. The correlation is striking. As China's direct holdings hit 14-year lows, the volume flowing through these proxy hubs has reached record proportions. While it remains speculative without access to classified ledger data, the timing suggests a desperate shell game. The U.S. is not finding new, organic demand for its debt. It is relying on a shrinking circle of allies to mask a fundamental exodus. This is the structural fragility of late 2024. The world's risk-free asset is now being propped up by a mask that is beginning to slip. The $688 billion exit we are witnessing isn't a disappearance of wealth, it is a metamorphosis. Beijing has realized that in the current era of financial attrition, there is a fundamental difference between wealth and utility. As of late 2024, the Chinese strategy has shifted from accumulating digital IOUs to securing physical atoms. This is the Great Migration, the systematic conversion of US dollar denominated debt into a massive physical war chest. In this new paradigm, commodities have become the new global reserves. While the US Treasury was once the world's gold standard for safety, it is now viewed by Beijing as a permission based asset, subject to the whims of Washington ES foreign policy. To counter this, China is building a reserve system that cannot be deleted by a keystroke or frozen by a central bank. Nowhere is this more evident than in the energy sector. While the U.S. Strategic Petroleum Reserve reached historic lows in recent years, industry reports indicate that China has been aggressively filling its own vaults. As of Q3 2024, analysts suggest China's crude oil stockpiles have expanded to cover over 100 days of import protection. In the clinical logic of Beijing, an oil tanker in a domestic port is a far more reliable reserve than a treasury bond sitting in a New York custodial account. You cannot fuel a naval fleet or a manufacturing base with a frozen digital credit. This hoarding extends to the nervous system of modern industry, copper. Trailing 12-month data shows that even as China's domestic property market faced headwinds, its imports of refined copper and copper concentrate hit record levels. This suggests the stockpiling is strategic, not just commercial. By converting depreciating paper into industrial metals, Beijing is essentially prepaying for its long-term industrial survival, ensuring that a future trade war or blockade cannot starve its high-tech manufacturing sector. Perhaps most critical is the silent stockpiling of calories. Industry reports indicate that China now holds more than 50% of the world's global wheat and corn reserves. This is sanction proofing 101. If the US were to attempt a 2022-style financial freeze or a maritime blockade, these massive stores of soybeans and grains provide a multi-year buffer against the kind of food inflation that collapses regimes. This transition marks a historical reversal. For 50 years, the global reserve system was backed by the full faith and credit of the United States. But as of late 2024, China is moving toward a resource-backed reality. They are trading paper assets, which Washington can weaponize, for hard assets that require a physical confrontation to seize. The $688 billion figure we see today is the direct result of this pivot. China is trading its paper for power, building a physical fortress that the US Treasury simply can no longer penetrate. While the Great Migration into hard assets secures Beijing's future, it leaves the American consumer to foot the bill for the divorce. This is not merely a balance sheet adjustment, it is a direct structural pressure on the American standard of living. As of late 2024, the mechanics of this fallout are becoming impossible to ignore. When the world's largest creditor stops buying and starts selling, the fundamental law of supply and demand takes over. To fund a national debt exceeding $35 trillion in the absence of Chinese demand, the US Treasury must offer higher yields to attract alternative buyers. In the high for longer interest rate environment of late 2024, these rising yields act as a gravitational pull on the entire domestic economy. For the average viewer, this translates into permanent upward pressure on mortgage rates, auto loans, and credit card interest. The era of cheap capital is being sacrificed on the altar of geopolitical realignment. Beyond borrowing costs, we are witnessing the crowding out effect in real time. Industry reports indicate that as the federal government competes for a shrinking pool of global capital, private sector innovation is being starved. When the Treasury must offer high returns on risk-free debt to replace Chinese capital, the capital that would normally flow into small businesses, tech startups, and infrastructure is diverted to fund government deficits. This slows domestic growth and cements sticky inflation. Furthermore, analysts suggest a dangerous feedback loop is forming. To service the interest on existing debt, which now consumes a staggering portion of the federal budget, the Treasury must issue even more bonds. This creates a debt spiral where the US is effectively borrowing money just to pay the interest on what it already owes. The clinical reality of late 2024 is that the divorce from China is inflationary by design. As Beijing trades its paper for physical commodities, the US is forced to maintain high rates to protect the dollar's value. For the American viewer, the $688 billion sell-off is not just a headline, it is a primary driver of why your purchasing power continues to erode. The price of the divorce is being paid at every gas pump and checkout line in America. As of late 2024, the $688 billion sell-off has transitioned from a geopolitical headline into a structural market reality. This exit creates an environment defined by thinning liquidity and heightened volatility. Institutional analysts are currently monitoring warning bells like the USD-JPY exchange rate, which often serves as a primary indicator for global dollar liquidity. When the yen experiences extreme fluctuations against the dollar, it signals that the traditional financial architecture, once stabilized by massive Chinese holdings, is under significant strain. In this era of financial attrition, institutional playbooks are shifting toward defensive resilience. Many sophisticated market participants are prioritizing short duration assets. By focusing on short-term bonds, these entities aim to mitigate the duration risk associated with long-term Treasury notes, which remain vulnerable to rising yields as the U.S. struggles to find new buyers. Furthermore, as Beijing continues its great migration into physical commodities, market observers are increasingly looking at hard asset producers. This involves shifting focus toward companies with physical production capacity, specifically in the energy and industrial metal sectors. Analysts suggest that in a high inflation resource backed reality, the value may migrate from digital promises to pay toward companies that control the total atoms of the global economy. The $688 billion exit is a signal that the global financial plumbing is being rerouted. For the domestic observer, the priority is no longer chasing speculative growth, but understanding the mechanics of this new, low liquidity paradigm. Disclaimer: this analysis is for educational purposes only and does not constitute financial advice. Consult a certified professional before making investment decisions.